So you got some extra cash and you want to invest it. But if you're new to this, things can get overwhelming pretty fast. So let this be your ultimate beginner-friendly guide to investing in 2026. We'll break this video down into 5 main parts. Part 1 is the real reason you should be investing. Part 2 is what you should invest in. Part 3 is when and how much you should invest. Part 4, a live walkthrough while I'll actually buy a stock on camera. And Part 5 is about investing strategy and common questions like taxes. Starting with Part 1, why you should be investing. The main reason is because you want to put your hard-earned money to work so you can make more money. Let's say you have an extra 1K. What are you gonna do with it? You could buy 4 overpriced iPhone pockets, tuck it on your mattress, or stuff it in the bank. The problem is inflation, which makes your money lose value over time, meaning you won't be able to buy as much stuff with it in the future. If an orange cost $8 last year, but now it costs $10, that $2 increase is inflation. So instead of letting your money lose value over time, the better option is to invest your extra 1K into the stock market, because investing not only grows your money and your wealth, but it also protects it from inflation. So how does this work? Well, there are 2 ways your money grows when you invest it. First, when you invest in something like Apple, the company, you basically own a bit of Apple's business. So if Apple's business is booming, like they sell a ton more iPhones and they make more money, then Apple, the business, will be worth more and your money grows because the business you own is a bit more valuable now. The second way your money grows is with compound growth, which is just a fancy way of saying you're earning money on the original money you invested and you're earning money on all the extra money your original money made. Sounds very confusing, so we'll go through it together. Remember that extra 1K we talked about earlier? Well, let's say you invest it and it grows by 10% every year. That means by the end of the first year, you now have $1,100, your original 1K plus $100 in growth. Now here's where compound growth gets interesting. In year 2, you're not just earning 10% on your original 1K anymore, you're earning 10% on the full $1,100. So you make $110 that year, bringing your total to $1,210. In year 3, that 10% growth is now $121, bringing your portfolio to $1,331. So see what's happening, right? Each year, we are making money not on just on our original 1K, but on all the growth from the previous years as well. It's like rolling a snowball down a hill. As it rolls down, it picks up more snow, it gets bigger and faster, which is why Albert Einstein calls compound interest the 8th wonder of the world. All right, so you have an idea on why you should invest, but what should you invest in? As someone who used to work on Wall Street, I've seen many times people just think, I'm just gonna look at what stocks grew the most and invest in that. It sounds like a smart strategy, but here's why that doesn't work. So in 2010, Nokia, which no one really uses anymore and is only known as being an indestructible phone, well, Nokia was the leading phone brand. They own nearly 38% of the market share. But by 2020, their market share dropped to less than 1% and their stock price fell by almost 70%. And if we go back in time by 40 years to the 1980s, the biggest companies in the world look very, very different from today. In the 1980s, the big dogs were the oil and gas companies, right? General Motors, DuPont, Gulf. If we go back just 20 years to the early 2000s, the big dogs again looked very different. It was Exxon, Walmart, and Cisco. And now today, the biggest companies are Nvidia, Tesla, and Google. The point is, just because a company did well in the past doesn't mean that it will continue to do well in the future. So one suggestion I always share with people who are just beginners is that you are better off not investing in individual companies on day one. We've all heard the saying, don't put all your eggs in one basket. Because if you invest all your money into one company, like Mr. Magic Lamp Company, this is like putting all your eggs into one basket. All right, Vincent, enough. So what should we invest in? The quickest and lowest effort way for a beginner to start investing is to look into these things called index funds. Index funds are a great option, especially if you want to start investing without having to be incredibly lucky or having to check the news every day. Instead, with index funds, you pretty much just set it and forget it. Even Warren Buffett, who is arguably the greatest investor of all time, said that most investors, both institutional like hedge funds and individuals, will find that the best way to own stocks is through an index fund. But Vincent, what the heck is an index fund? I'm glad you asked. The easiest way to understand what it is to break the word index fund into 2 cards. Starting with index. An index is just a list of companies. You've probably heard of the S&P 500 before. The S&P 500 is an index. It's basically a list of the top 500 largest companies in the US. Now, a fund is essentially a pot of money that is pooled together from a bunch of investors like you and me, and this pooled money is then used to buy something. So putting these words together, when I say invest in an index fund, that essentially means we are taking our money, putting it into this pooled money, and this pooled money is used to invest in a list of companies. One of my favorite things about index funds is that it instantly reduces your risk of losing money because you have a bunch of eggs spread out across a bunch of different baskets. If you drop one basket, you still got other eggs. And now I want to show you what an index fund actually looks like. All right, so this is QQQ, which stands for Invesco QQQ Trust, and this is an index fund that tracks this thing called the NASDAQ 100. And the NASDAQ 100 is essentially a list of the 100 largest tech companies in the US. So if we dive deeper into QQQ, we can see exactly what they're tracking by going to what they're holding on to. All right, so the top 10 holdings, which constitutes around 52.92% of the total assets in this index fund. The top 5 is including NVIDIA, Microsoft, Apple, AVGO, Amazon, and so on and so forth. Now, what this means is NVIDIA makes up about around 10% of this entire index fund. In other words, when you invest in an index fund like QQQ, you are essentially investing in all these different companies. One thing to keep in mind when investing in index funds is that they all come with fees. And in the investing world, this is called an expense ratio. These fees cover things like admin costs, maintenance costs, whatever the fund needs to manage itself. For example, if we invest in a fund with an expense ratio of 1% and we have $100K in that fund, that means that we'll pay $1,000 per year in fees. Now, we don't actually get a bill at the end of the year, it's just automatically taken out of our investment. Generally, a 1% expense ratio is considered pretty high, but the good news is there are index funds out there that I'll share with you later in the video that have a very low expense ratio, like around 0.1 to 0.5%, so you don't have to worry about the extra fees too much as long as you select the right index fund. All right, so now you know generally what you should be investing in, but when should you start investing? This might be an unpopular opinion, but I don't think everyone should be investing. I think it is entirely dependent on how you answer my next two questions. Number one, do you have any high interest debt with more than 10% interest rate? If yes, you should prioritize paying off those debts first before you invest your money. If you don't, it's like trying to put gas in your car while knowing you have a hole in your gas tank that is leaking gas. Because look, let's say we have $10,000 cash and we invest in the stock market that has an average return of 10%. We gain $1,000 in a year, which is fantastic. But if we also owe $10,000 on our credit card that has a 25% interest rate, then we're going to be paying $2,500 in interest fees at the end of our year. Meaning we'll actually end up losing $1,500 overall. That's why I think that if you have high interest debt, you should use that extra money to pay the debt down before you invest. The first priority is to fix the leak. The second question is, do you have 3 to 6 months of an emergency fund? If not, and we run into an emergency, knock on wood, then we might be forced to use our credit card or be forced to sell our investments at a loss to cover our emergency. So for most people, before you invest, my suggestion is to take care of your high interest debt and your emergency fund first. Now let's talk about how much money you should invest as a beginner. First off, we can start investing with just $1. All right, we don't need a ton of money to start. But obviously, how much you make in the stock market is going to be limited by how much money we put in. For example, if we invest $10 and our stock goes up by 10%, we're only gonna make $1. But if we have $50,000 invested, a 10% increase means we'll make $5,000. The rule of thumb I tell everyone is this, right? You should only invest an amount of money that you don't need for several years. So if you're trying to save a bunch of money for a down payment on a house in the next year or two, then you probably shouldn't invest that money right now because you'll need it soon, and it's impossible to know if the stock market will go up or down in such a short amount of time. And anyone who tells you they know for certain is lying because no one can predict the future. The point is you only want to invest money you don't need for the next several years. All right, so now let's talk about how we can invest in our first stock, and then I'll do a live walkthrough of me buying some stocks. There are two main ways you can invest, right? First is with these fancy retirement accounts that you might already have, like your 401k and your Roth IRA. The benefits of investing with these accounts are the tax advantages they offer. The downside is you typically can't withdraw money from these accounts before you retire without paying some penalties. If you don't have or you don't want to invest with your retirement accounts, the other option is with a regular brokerage account. Some popular options are Fidelity, Schwab, SoFi, Moomoo, etc. The benefits of a brokerage account is that you can deposit, withdraw, and invest whenever you want. The trade-off is it doesn't have some of the fancy tax advantages that retirement accounts have. The first step to invest with a brokerage account is to sign up for one that works for you. Nowadays, all major brokerage accounts like Fidelity, Schwab, and SoFi, they offer the same basic functionality. I personally prefer SoFi, which is what I'm going to use on this live walkthrough. And the reason I recommend it to people is that it's one of the best beginner-friendly options available. It's super simple and easy to use. But it's up to you. If you are interested in SoFi, if you sign up with my link down below or scan the QR code over here, there's actually a promotion right now where you can get up to $1,000 in stocks for free when you open and fund your account with just $50. I don't know how long that promotion is going to run until, so if you want, you can pause the video, sign up, and then come back. All right, so step two is after you sign up for your brokerage account, you want to log in, and now you want to move money from your bank account into your brokerage account so you can actually use that money to invest in the stock market. I'm currently in the SoFi Invest app right now. This is my example account that I use to demo these live walkthroughs. And if you're adding money here, you can just go to trade and then click on add cash and make sure your bank account is connected. And then you want to type in however much money you are comfortable with. For example, $100 or $50 or even $10, and then click on review and continue. I already have some money in this account, so let's move on to step three. Next, we're actually going to search for whatever we want to invest in, whether that's an individual stock, an index fund, or whatever type of investment. All right. So for this purpose, let's just say we are interested in Apple stock. So what I would do here is click on trade, click on buy and sell, and in the search bar, I would type in Apple. And then we're brought to all these options. I'm going to click on the first one over here, and we're brought to Apple's stock profile page. Essentially, how much Apple is currently worth. We can look at the chart over here, the past week, past month, and so on and so forth, and how the price performed over the past time frame. You can also scroll down if you want to learn more details about the investment, any related news for that particular investment, etc. But for this example, we're just going to move forward and click on buy. Now, one thing that's really cool about SoFi and why I say it's so beginner friendly is that when you do a market order, which is essentially you want to buy Apple stock in this case, it actually gives you two options. The first option is buying Apple stock in dollars, and the second option is buying Apple stock in shares. It sounds way more confusing than it actually is, but essentially when you decide to purchase shares, you are specifying the exact number of Apple stock that you want to buy. So for example, if you want to buy 10 shares of Apple stock or 10 stocks of Apple, and Apple is trading at $180 per share, then your order, how much money you would need, would be 180 times 10 or $1,800. The other option is if you select dollars, you basically specify the total amount of money that you want to invest, and then this will automatically calculate how many shares of Apple that will buy. For example, if we only want to invest $1,000 in Apple stock, and Apple is trading at, let's say, $180 per share, then we would receive around 5.56 shares of Apple stock. In other words, we are buying fractional shares of Apple. So which option should you choose, shares or dollars? Well, to simplify it, if you have the money to buy entire shares of Apple, just pick shares. If not, then just pick dollars. It essentially is the same thing. In this case, I'm going to be selecting shares, and now I'm brought to this buy order page, and a couple of things to focus on and pay attention to is essentially buying power, which means how much money you actually have in your investment account. In this case, I have around $430. Next, you can see the market price, which essentially means how much Apple is currently trading for, or how much it costs to buy one share of Apple, so $277. Meaning I have enough buying power or cash to purchase at least, right, one share of Apple. So I'm going to type in one share here, and now it tells me my estimated cost of $277 per share. Now I'm going to click on review, and then I just have to slide to confirm this purchase. And boom, your trade is all set. You just click on done, and now you can see that I own one share of Apple at a value of $277. Congratulations, you just made your first investment. And if you want to sell a stock, it's essentially the same process. You go back to the Apple page, click on trade, and you click on sell in this case. Now, a very common question people ask me all the time is, how long should you hold this stock or investment for before you sell? My suggestion, especially for beginners, is to hold your investments for the long term, which is more than 3 years. In fact, I go so far as to say, don't even look at your stocks after you buy them. As someone who used to work on Wall Street, a very common mistake I see many people make is that they let their emotions drive their investing decisions. For example, since we are all human, when we see our investments or our stocks going down, we get worried and we decide to sell, which again is absolutely a normal human reaction. But this thing called panic selling is really how most investors lose money in the stock market. And I want to show you something really cool that shows why panic selling is not the greatest decision, especially if you're trying to build wealth. So let's look at QQQ again. All right, so to give you some context, right now we are in basically the price performance chart for the investment QQQ over the past couple of decades. And right now we are in the year 2007, right? Hypothetically, let's say you purchase QQQ at its 2007 price peak at $50 per share. Then unfortunately 2008 happened, and then the financial crisis happened, and then all the stock market basically started falling down. To the point that down over here, let's just say your investment in QQQ fell down to its $20 price range, which sucks because your investment basically halved at this point. But remember, if you are investing for the long term, you haven't actually lost any money because you haven't sold your investment. Meaning if you just held onto your investment, then fast forward to the year of 2010, then you can see the price returns to around $50 and now you break even. Then fast forward to, let's just say, year of 2018, then we can see QQQ is now worth $170 per share. And if you kept on holding to today of December 2025, QQQ is now worth over $600 per share, meaning you just 12x'd your money. But that only would have happened if you invested for the long term and you didn't let your emotions drive your decisions. In fact, there's a study by this investment research firm that backtested 10 years of stock market data and found that if you missed the 10 best market days, meaning you kept trying to sell when the market was down and trying to buy when the market was up, then you would stand to lose, on average, 66% of the gains you otherwise would have made if you just stayed invested in the long term. Meaning if you invested 100K and you just held it for the long term, let's just assume it goes up to 200K. But the study is saying that if you let emotions drive your decisions, you might only end up with 144K. And the simple explanation is when the market moves up, it moves up very quickly. Which is why it is crucial to stay invested, because it is impossible to perfectly time the market, which is why time in the market is much more important. In fact, there's data that shows 90% of people who take on day trading or super short-term investing, they end up losing money. Some studies say only 1% of day traders are profitable. You see, some of the best investors in the world, they just buy their investments and then they forget about them. Because over the long term, there's a really good chance that your investments will be much higher than what it is right now. All right, so as promised, here are 3 index funds with pretty low expense ratios that you might want to look into. The first is SPLG, which stands for Spider Portfolio S&P 500 ETF. It tracks the S&P 500 and, like I mentioned earlier, has the 500 largest publicly traded companies in the US, which gives you exposure to well-established businesses that represent about 80% of the stock market. It has an expense ratio of 0.02%, so pretty low, and investing in an S&P 500 index fund is ideal for investors who want a balance of stability and growth. Next, there's VUG, which stands for Vanguard Growth ETF. VUG focuses on growth companies, meaning these companies are expected to grow faster than average because they have revolutionary technology. But while they have the potential for faster growth, they are riskier because as much as they're likely to go up fast, they're also likely to go down fast as well. So VUG has an expense ratio of 0.05%. So again, it's pretty low. Growth funds, these are ideal for younger investors with a higher risk tolerance and a longer time horizon because they have the time to outlast any market volatility while taking advantage of the higher returns. Next is SCHD, which stands for Schwab US Dividend Equity ETF. This fund focuses on large dividend paying companies, meaning these companies will pay you cash every so often. It has an expense ratio of 0.06%, so again, pretty low, and is more ideal for people who are older investors with lower risk tolerance or people who value passive income cash flow from these dividend payments. Next, let's quickly go over 2 things you need to know when it comes to taxes. Since your investments are a form of earning money, the US government is going to want a slice of that pie. And the size of that slice is determined by how much you profited or lost after you sold your investments. For example, if we bought Mr. Magic Lamp stock a year ago for 1K and things went really well, it went up to 1.5K, and we decide to sell today at 1.5K, that means we made a profit of $500. And that $500 will be taxed. If the opposite happens and I sold Mr. Magic Lamp stock for $700, then that means I lost $300. And now I can deduct the $300 from my taxable income. The second key thing to keep in mind when it comes to taxes is you can get taxed more or less depending on how long you hold the investments for before you sell it. For example, if we only held Magic Lamp stock for the short term, which basically means we held it for less than a year, then we generally will get taxed at a higher tax rate than if we held it for the long term, which means you held it for longer than a year, which is another incentive to invest for the long term if you want to pay as little taxes as possible. Without a doubt, investing in 2026 is one of the best ways to make your money work for you and build your wealth. But this only comes second after you know the right payday routine after you get paid. Click here to find out what you need to do every time you get paid.